Hello everyone and welcome to Pivot Boss Masters. In this training we're going to be discussing advanced risk and portfolio management. This falls under the core training and specifically the execution portion of core training that we have in our Masters training catalog. For the most part, what we're going to be looking at today is how to mitigate risk at the entry of your trades, basically dipping the toe into a trade. We're also going to look at how to minimize portfolio heat and how to calculate the various equity models that we want to use for our risk assessment and risk management approach. So we're going to be delving into some pretty powerful topics here. We have about 9 slides, and let's go ahead and get started with advanced risk and portfolio management. Here's the agenda that we're going to be following for today's session. Basically, advanced risk and portfolio management. These concepts here really help teach traders how to mitigate risk, how to basically stop the bleeding here if some catastrophic event occurs, how to assess risk and opportunity on a per trade basis or on a period of time when the market may be doing something significant. Maybe that's a time where you can push your chips in more. Maybe the market is extremely volatile or not really engaging at all, with little volume. Then those are maybe times that you might want to pull the chips back a little bit and maybe dip the toe into the water to see if the opportunity will continue to progress. So what we're going to be doing here is looking at a few topics. Number one, assessing your risk profile. It is important to assess your risk profile as a trader, as tailoring an approach for your risk tolerance offers better odds for success and helps preserve mental capital. This is something I talk about a lot, and I know this is very, very common knowledge sometimes. It's what is your risk profile or risk tolerance as a trader? We hear about it all the time, and sometimes when you hear about these things all the time, that's about the time when many folks kind of push that to the side because they've heard it before. It's not new, it's not sexy. But it's really true. Understanding your risk tolerance and your risk profile is very important. We'll talk about this a little bit more because you're going to want to tailor an approach that fits that profile so that you don't lose your hair too early or have a heart attack from the stress because of the size of your positions. Right? You have to have something that's going to allow you to allow the trade to work out and give it time to trade. And oftentimes that's all goes back to position sizing and risk profile. So we'll talk about that. Equity model calculations. We're going to talk about 3 different equity model calculations. These help give you an understanding of how to calculate your equity so that you can begin calculating how do you want to risk portions of that account. So that we're going to talk about those 3 models here in a bit. Number 3 is percentage risk position sizing model. We've talked about this one often. This is the model that I prefer. This model offers an easy and consistent approach to position sizing that anyone can use regardless of account size. This model is also called the fixed fractional position sizing model. So we'll talk about that one as well. Portfolio heat. This is important. Again, another very simple yet powerful concept. Limiting the amount of your portfolio that is at risk is extremely important, and this helps avoid those ruinous times where you see those major flash crashes or any high volatility events where the market can drop 10% in a matter of hours or a couple of days because of some significant event. So again, portfolio heats will something we'll talk about. In terms of scaling into trades, we're going to deal with that and kind of look at some charts on how we will be looking to engage scaling based off of the risk or opportunity presenting itself. For the most part, scaling into trades provides a prudent approach to mitigating risk at the outset of a trade, and then it provides flexibility to allow you to add to that position as it continues to prove itself, or perhaps to dollar cost average in case it goes against you at the outset. So again, we'll talk about those. And then scaling according to risk and opportunity. This is basically scaling into trades according to merit, and basically the better trades get better entries or better percentage of account versus trades that aren't as good, where you would likely dip your toe or avoid altogether. So let's go ahead and get started with the rest of this agenda. And number one, we'll be talking assessing your risk profile. So it's important to assess your risk profile. We've already talked about this as tailoring an approach that fits your risk tolerance offers better odds for success. And again, that preserving mental capital is so important. Very difficult for a trader to put on a trade and let it play out if that trader is super stressed out about the size of that trade, right? That's a trade that if you're stressed out, if you can't sleep at night because of the size of that trade, it's probably not a healthy trade for the account. It's probably too big. And especially in recent years, as volatility has dried up and also as volatility has picked up significantly, I think it's been a better approach to kind of lower or reduce the amount of contracts or shares that you're putting into these trades at the outset. And so I think it becomes an approach where, depending on your risk tolerance, you can hopefully move among these categories instead of just sticking to one. So a lot of times a conservative trader with a conservative risk profile will only trade a certain way, regardless of the market at hand, right? Not every market should be traded exactly the same. And so it is my goal that you would look at these categories: conservative risk profile, moderate risk profile, and aggressive risk profile, and understand when you would like to use each of these profiles when the circumstances arise. For example, conservative risk profile, this is a conservative trader who focuses on capital preservation and growth. They're not trying to lose what they have. They'd rather preserve that capital and add to it. And they're seeking to limit their risk exposure, but they're also looking to produce income producing trades, right? That's the goal for a conservative risk profile. For a moderate risk profile, you have somebody who's a moderate trader that focuses on growth and looks to increase or decrease their risk exposure according to the odds of profitability for a given opportunity. So a moderate risk profile will basically increase or decrease their exposure based off of the circumstance at hand. So if something's extremely risky, perhaps this moderate risk trader will fall back to a conservative risk profile. If the odds are great and you're seeing a lot of great aggressive movement based off of your assessment, then you can perhaps jump into the aggressive risk profile and be more aggressive about adding to that position or triggering the initial position. So an aggressive risk profile would be a trader who seeks to rapidly grow an account and will place directional bets and add to these bets as conditions become more favorable. These traders look to capitalize on golden opportunities by adding more exposure to the market. This is really when you start to jump into kind of advanced trade management, where you get to a point where you're such a good trader you can effortlessly flow in and out of these various categories. So again, this is something that I try to do very, very often, where if the initial, let's bring this up over here. If an initial trade looks fantastic, an opportunity is setting up, you have significant market structure here, right? And then all of a sudden you have your classic significant rejection here, and you have a nice little signal there, and you have a rejection, and everything is playing out. And say the trend had been up, and say all the market is starting to work higher, and all the factors are working into each other. This is an opportunity where you can be a little bit more aggressive in your approach, because you know that this likely has great odds. That's a time where you can put it all in. Another time would be perhaps when, say, you have some sort of behavior here that's compressing, and then you have the stop run day, the expansion day. That stop run day, that expansion day is significant. It can be a huge range day, and if you can identify that day early on, that it's playing out, this is when you can be very aggressive on that type of day and add to it. Other times, a market may be coiling very quietly and not much doing of anything, and that's a point where you may want to be more conservative in your approach. Maybe not put anything at risk, maybe only put a portion of available units at risk in that quiet atmosphere. But when things pick up, you may want to jump into one of these others. So again, I don't believe that this is something where you can just stick inside. I mean, some traders will just be conservative. Some traders will be super aggressive. Some will be somewhere in the middle. But I think that it's your ability to effortlessly flow into and out of each of these categories as the market presents opportunities. I think that's very, very important. So your ability to say, this is when I should be more conservative. This is when I need to be aggressive. This is when I need to be a little bit more in the middle. That I think is very, very important. So again, this isn't anything that's you probably haven't seen before, but the idea is learn to read a market and read the circumstances that would want you to be more aggressive in that instance, or want you to be more conservative or more moderate. And I think that takes a little bit of practice, but once you understand those opportunities, that's when you know. I know that there are certain days when that day is happening, I want to be aggressive. Or when certain things are happening, I want to be conservative. The rest of the time, I'm probably moderate. I'm in the middle. Right? Mostly in the middle, and then if something sparks me to be aggressive, I'll be aggressive. If something sparks me to be more conservative, I'll be conservative. So that's kind of the approach for me. If you do this kind of in terms of, again, a Gaussian distribution, right? You got right here, one standard deviation on either side of the mean is 68% of prices, and then the rest kind of go out this way, and the rest kind of goes out this way. To me, this would be moderate, this would be aggressive, and this would be conservative. Most of the trades are going to be somewhere in here, right? Moderate, where you're kind of in there, and oftentimes you're going to have to be very conservative. Other times you're going to be more aggressive, but for the most part, you're somewhere in here. And learning to go in and out of those, I think, is very important. Now, this is where we're going through a progression right now. The progression is understanding how we want to expose ourselves to the market in terms of risk, right? How much risk exposure do we want to have? And it all kind of goes with, number one, understanding what is your tolerance, what's your risk tolerance or profile, or what is the tolerance that should be used, or the profile that should be used for that instance in the market. And then we're flowing into, now let's talk about how much money you have, and how much money do you want to risk of that, and how much overall money do you want to risk of that position, those types of things. So number one is over here. This is about the risk profile. And number two, now we're talking about equity model. The equity model calculation is all about understanding how you want to calculate your equity. And that sounds silly because equity is just what's the bottom line, what's available. But these three models here are designed to give you flexibility on how you want to risk your money there and portions of that equity. And each of these will expose you to the markets in a different way. Thus, the returns will be different as well. So they're different. So number one, the core equity model. This model calculates available equity by subtracting the amount at risk from open positions. So this model allows you to risk a percentage of the equity that is not at risk by these open positions. So let's just start with, just say 100K account. Okay? And say you want to risk, 1% of that account. That's $1,000. So say you get into a trade and you're going to risk $1,000 now. That drops you down to 99 right here. Right? And so now when you go to take the next trade, the second trade, this is trade 1 right here. When you go to trade The next trade, say you're still in this position and you have 1,000 at risk still. The next trade, you're only going to be able to risk $990 because it's of the core equity. It's of the money that's not at risk, right? So again, if you go to the third trade, subtracting 990 from 99,000, you would subtract 990 from 99,000. Whatever that number is, now you would take 1% of that, right? So basically, that's your core equity model. Basic equity model. The total equity, this is more along the lines of what I've been doing for a very, very long time, but this is basically, this model calculates the available equity. So here's your available equity, and then it adds to it any P&L, any profit and loss. So say you have two positions, you have a 100K account, and you have two positions that are in trade, and they're both up a combined, say, $2,000. So now you can add that 2,000 here, and you have 102 as your total equity. And now your next trade can risk this much. 1% would be now this. So basically, it's taking the profit and loss and adding it to the current equity, and you can use that account. So total equity. So it allows you to lose a little bit more, right? So that's that one. The reduced equity, the reduced total equity model is kind of a combination of the two. The initial position is based off of this core equity. So you have, say, 100K. 1% would be 1,000. Okay? So it starts off just like this one. Now, when this trade starts to produce profit, say it starts to go in the money and now it's up $1,000. Well, as long as you lock in those profits, now you can add those profits to your equity, and your next trade can be a percentage of that total. So basically, it allows you to add net profit, so long as your stops are applied to secure those profits. So those are three different approaches that you can use. A fourth approach right here that I really like, which is not an equity model, but it's kind of goes based off of this approach here, is say you have a 100K account, and say over the course of the month you've made, say, 10K. So if you were only risking 1% of this account, that would be $1,000. So now this right here is money that you've made over the course of the month. So because this is profit, you can use a higher percentage of profit. So say, for example, you want to use 2% of profit, right? So 2% of profit would be, say, 2% of 10K. Oops, I just deleted all that. Can I go back? Yes, perfect. So now you would take 2% of 10K, and you would take 1% of 1,000, and now you would add those two together, and now that gives you your percentage that you can risk for your next trade. That's a fourth approach there. And so it's allowing you to use a bigger portion of profits instead of actual base equity. Now, say at the end of the month, you end the month with 110,000. Well, now you can reset this as the base equity for the next month, and now any profits on the next month would be subject to this. So that would be a fourth approach over here. That's basically allowing you to use a percentage or fixed risk on profit. According to many, many studies, you can go anywhere between 1 and 2%, or even higher, depending upon how you want to play it, and we'll talk about that. But all of these right here provide a way for you to manage your risk and the amount of percentage that you want to put out there of a total equity or of equity with profit and loss. Anyways, great approaches. Again, this is a very simple approach. I'm about simplicity. This one right here, it's a little bit more involved. I really like a total equity approach. This has been the model that I've used forever, since the Nirvana days, way back. This is an approach we used in our portfolio simulator. And so I really like that one. Basically, it's base equity plus P&L, whatever that total is, and that total gives you the amount that you can risk your percentage on, whatever that may be, 1%, 2%, 10%. Don't do 10%. So those are the total equity models. And now that you understand the models, we can talk about risking a percentage of that. So now this is the percent risk position sizing model. The percent risk position sizing model is also known as the fixed fractional model, and this approach offers a simple yet powerful approach to position sizing that can be universally applied to any account size or trading style. For those of you that have watched part 3 of Swing Trade Pro, the first, you remember this nice little chart right here. Basically, what this chart is showing you, and we'll get to it a little bit more, is the percent of account that's being risked. This is 1% of account per trade being risked. 2% of account, 3%, 4, 5, 6, all the way to 20%. And what this is showing is that if you were to trade only 1% of your account on each trade, just allocate 1%, it would take 390 losers in a row to get you basically to break that account. If you were going for 2% of trades, 2% of account on each trade, it would take you 194 losers in a row in order to basically break that account. But look at how, from 1% to 2%, this thing gets cut in half basically. And then from there, boom, right? So you never want to risk a ton of an account on one trade. And so over here you see the percent risk model basically determines the position size as a percentage of equity. So if you're using the total equity model, you would take 1% or 2% or whatever percentage that you choose of that total equity, and that would be the amount you use for the next trade. So for new or conservative traders, you typically want to risk no more than 1 to 2% of account size per trade, with 1% being the preferred amount to risk. Now, I've mentioned this many times before. I've done so many portfolio simulations with this information. Again, PhD math professors teaching me as well. And doing so many simulations over time, if you start to go over 2% and you're not a good trader, things happen very fast. That's why so aggressive traders typically want to risk no more than 2.5%, 2 to 2.5% if you're a good aggressive trader. And then you typically never want to allocate more than 5% to any one trade. And again, if you're super aggressive, perhaps you can build into a trade starting with 2.5% of equity and then building up as high as 5% if that trade continues to warrant the reward there. So basically, this is the guideline right here. You want to trade somewhere between 1 and 2%. So in terms of this, 1 to 2%, again, when we did portfolio management simulations on this, 1 to 2% was always the best approach. And so typically 1% is a great amount to risk. 1.5% is usually my preferred. I like a 1.5%. It's a little bit more aggressive but not quite into 2. And then at times, so this would be on total equity. And then over the course of, say, a month or a quarter, in terms of profits, 2.6% of the net profit, right, could be used as well. So you would use 1.5% for total equity, and then you would add to it 2.6 of whatever net profit you have, and now that gives you a risk amount for your next trade. And again, that total equity plus profit would reset whenever you're ready, right? You know, at the end of the month it would reset, or the end of the quarter, or whatever you want. So again, 1 to 2%. I'm usually somewhere about 1%, 1.5%. I would say that, again, it's super liberating and freeing to have a position on with 1% or even 0.5%, right? Depending upon what you're doing, and not be risking so much that you're freaking out on every single wiggle, right? If you can sleep at night and you have 5 positions on, you're doing something right, because again, you've mitigated that risk, you've wrangled that risk in, and you know that you have it all under control, right, in terms of those risk controls. Yeah, hey Eric, I'm glad you were able to get back on and get to the audio here. In terms of your question, total position size, you're talking total position size. Assumes it's all at risk. Yes. So total position, I'm talking amount at risk. So this is very important here, and I'll do a little calculation here. So basically, say, again, I'll go with the 100K account. You're risking 1%, and that equals 1,000. Okay? So that is the amount that you're willing to lose on the next trade. Which means now, if you are looking to trade the ES, okay, and you're looking to day trade it, then you would look to see where's your stop. Okay, say you were going to get in here at 2,700. Maybe you have a 5-point stop or something like that. 5 times 50 is your points. So basically $50 a point times 5. What's that? 250. And then from there, 250 divided by 1,000 is 4. So basically, that's how the approach would go. If you're going to risk 1% of a 100K account, that's risking 1,000. So now if your entry point is 2,700 and you want to risk 5 points, then per contract, that's $250. You can trade as many as 4 contracts times 5 points. That gives you $1,000 at risk. And that's how you would do that. Now, what if I wanted a 10-point stop? Maybe this is a swing trade and I want a 10-point stop. Then you're doubling your stop, so you have to drop the contracts. You can go 2 contracts at 10 points, or at 10 points, and then do it that way. So basically, that's how the math would go. If you have a tiny stop, say it's only 2 points, then so that's how it goes. Basically, you're seeing how much is the most amount that you can risk and lose on that trade, and then from there you work in the actual size in terms of contracts or shares, and then against your loss. So the size of your loss stop will determine how many contracts or shares you can trade. Hopefully that makes sense. So again, I'm always about that 1% to 2%. I think this is aggressive. If you're somewhere in this line right here, I think you're doing good. And again, even if you drop it down a little bit more, 0.5%, it's not bad. I like a 1.5% risk per trade, but then we're about to get to the scaling portions here in a moment, and then you're going to see how I can scale that differently again. So let's talk about the next subject here, which is basically portfolio heat. This is another important topic here, but it's oftentimes overlooked, and that's portfolio heat, which basically This is designed to help stave off any catastrophic losses that your portfolio may incur when such significant events like a flash crash happens, or like in the market significantly tanking. And so basically, portfolio heat is saying what is the total risk to which your portfolio is exposed, the total amount risked. Say you have 5 trades at 1%, and each of them is, say $1,000 each. You might have 5% of equity at risk. So if you had that 100K account and each of your trades is about $1,000 right now of risk, and you have 5 trades, that's now encompassing 5% of your total equity. So if every single one of those positions were to hit their max loss, you're going to lose 5%. So that is very, very important, because as we know, when the market goes up, all of your long positions will rise. But then when the market goes down, all of your long positions will fall. And so we know that this, the rising tide lifts all boats and those types of things there. And it can be significant. So when the market tanked at the end of January, beginning of February, the S&P's up here, and then all of a sudden it goes boom. This is the time that can really hurt traders, when you're still hanging on here and this thing goes against you, and you can really get wiped out. If you're over leveraged, you can get wiped out. If your exposure is too high, you can get wiped out if there's a flash crash event, right? I mean, we've seen this happen. We just saw this recently where everybody was trading short volatility, right? VIX options, everybody's short. And then all of a sudden, volatility explodes, and those short trade went to zero, basically. And now people are wiped out. They were just, their portfolio heat, their exposure was way too maxed out. So a very good rule of thumb is to limit your max portfolio heat to 10%. Most traders should limit the total amount of equity at risk to 10%. You don't want more than 10% of your equity at risk at any one time, because again, if every single one of those positions hits their fixed loss stop, you're going to be down 10% of that account in a heartbeat. And again, all it takes is one major flash event, headline risk, anything like that for something like that to happen. So you always have to know that anything can happen in the market at any time. And so accordingly, you have to plan for those by reducing your risk, your exposure, and all the things we're talking about in this presentation help in some way. You'll see right here, 20% max portfolio heat. Experienced traders will use this, right? Super experienced traders will use as much as 20 to 25% max portfolio heat. You'll see super aggressive traders will do that. Some may even do more. But experienced traders, I would even say great traders, will do this, and there's no problems at all, because again, they understand when to flow in and out of that. And anytime you start getting too high in terms of max heat, it's a good time to start reducing exposure. A lot of times that can happen when you've had a big run up in your positions. Say you're holding 5 positions, the market rallies, your entry generally is down here, and now it's way up here. This is the point where you now have the most risk exposure now in terms of open positions, because not only is the risk that you have on board, but then now it's profit as well that's now risked, and that's about the time where significant events can happen. And so being able to scale at the appropriate times is very important. So again, portfolio heat designed to limit the amount of exposure that you have to a market, so that you don't get wiped out when you see those major price shocks that can occur, like a flash crash or like some kind of headline risk, right? Like a trade war and those types of things. So again, understanding this, very, very important. Yeah, XIV 130 to 5. That's incredible. I mean, that's just that's painful to see. In terms of the Nirvana percent of equity, I think it's fixed risk. Oh, fixed risk is the one where you can risk, say, 1%, but then you also have percent of equity. I more use this one, and I have to go back and really read the names again. They were all kind of close, and it's been a while since I looked at them, but fixed risk was the one we used most often with regards to the Nirvana portfolio simulation. Good question. Max portfolio drawdown. That is not the same. The max heat would refer to the amount at risk. So the equity at risk right now, that's your heat. The drawdown, the max portfolio drawdown, is about how much the equity drew down as a whole during that portfolio sim. So it's a little different. All right, so let's talk about scaling into trades now. We've talked about scaling into trades very quickly in our advanced trade management section, which is also at the execution portion of our core trading on-demand training. We didn't really go into it like we're going to go into it now, but we talked about scaling into position and basically partial entries, and how you can average down if price goes against you, and those types of things. What we're going to talk about here is scaling into a position in order to limit your risk at the outset of the trade, and then allowing yourself flexibility to add to winners, rewarding those winners, or perhaps even averaging down a loser. But you have to be very careful with that. So basically, scaling into a trade is a process of building a position. Building a position by first testing the trade with smaller size, and then adding more scales should the position begin to work in your favor. This approach offers a powerful way to reduce risk at the outset of the trade while allowing flexibility to add to winning positions. So, for example, say you can trade 3 contracts of the ES. A great way to enter trades, just as a general rule of thumb, is to enter with 1 contract first. Try a third of that. Scale into it. If price is sitting at support, but you're not super confident, but you think it has a good shot to return to value, you may want to dip your toe by buying just 1 unit at a time, right? Scaling into that trade with 1 unit. Now, say you are risking $1,000, which is 1% of your 100K account. You want to trade 3 contracts. Now, if you got into all 3 contracts here and you hit your max loss, you're done for $1,000. You're out. But if you approach it a different way and instead scale into the position a third at a time, you can get into a third here, and if price hits your max loss, you've only lost a third of what you had originally intended to risk. And now you can say, well, that wasn't a good opportunity. Let's go to the next one. And now you've considerably stopped the bleeding. Instead of losing a full 1,000 and a full 1%, you dipped your toe. It wasn't right. You only risked a very small portion, and now you're good to go. That is so freeing and so liberating, because again, it does something to your mental psyche to know, hey, I'm not in full size right now. I'm going to dip the toe with 1 unit. And so if I lose money on this trade, it's not a big deal. It's only a third of what I would have lost if I had a big trade, right? A full position. And so again, very, very powerful approach to limiting that risk ahead of time. Now, if price starts to push into in your favor and starts to push higher, now you can reward that strength by adding another third, perhaps. And as it continues to go, you can add another third and be into a full position. and allow it to basically graduate into a full position instead of just handing it the entire risk to that position right at the outset. So again, this is a very, very good way to mitigate that risk right away. Now say there's an opportunity that looks something like this, right? And it's a great trending market. You're in the trigger zone. You know this thing's going up, it's good, and you're a part of that one. Now price comes back and you want to get the next one as well. The trend is great. Everything's stacked and sloped, everything looks good, but sometimes the entry, you can be a little early. Maybe you got in here on a third, but everything still works out and it drops a little lower. The trending structure is still good, the CLVN still holding, everything's good, but now prices come back a little bit. This might be a spot where you can dollar cost average down in that trade and add a secondary third, right? Because you know that the overall trend is still intact. You were just a little early, and adding to that position on the push down can be a good opportunity. It can be a good way to approach that opportunity. Now, adding back to every single losing trade is not a good idea, but it can be beneficial to improve your cost basis. But I say down here, you have to use this technique sparingly. It can be very, very risky to add to a losing position. So right here, for experienced traders only, because again, if you can get into a thing where I'm adding to a position here and I think it's going to go up, then it does this, so you're going to add again, then it does this and you're going to add again, and all of a sudden all you've done is added into a bad trade. So again, I would not say to add to every single trade that goes against you. Instead, if you dip your toe and price does go against the position initially, if the conditions are still present for that trade to continue in the way that you believe, then you can add to that opportunity. But again, you have to be very, very careful. I would also limit the amount of scalings that you do to 3 or 4. I mean, if a trade is down here at support and starts to work up to, value, say CVPOC or something like that, then, ideally I want to be in on day 1 rejection, but sometimes that can happen and sometimes it can't. So maybe you want to be in on day 2. So now I'm in on day 2. Maybe that was a good day, so day 3 I want to add here. And basically that's pretty much it. I'm in 1 or 2 here, and now I'm just going to let this thing go and scale out of those as it goes in my favor. So you don't want to just scale over and over and over and just keep on getting in and you have 10 scales that you've gotten in. I don't think that helps as much. So 3 to 4 scales max and you're good to go. But other than that, the goal with scaling into a trade is to build a winning position and reward those winners. Build a position in a winner and keep letting it pay for you. So that's an approach here, and we'll look at this in terms of charts here in a moment. Good question here by Dwayne. How does the T1 concept work with a scale in? And now that is a very, very good question, and we can talk about that here in a moment. I'll address that here in a second. Let's go to the next slide and then we'll talk about that. So the next slide is scaling according to risk and opportunity. So scaling into trades according to your risk profile or according to the opportunity presenting itself offers a powerful approach to risk management. Depending on your assessment of a given opportunity, you can scale into trades with conservatively or more aggressively. And so the idea here is, remember, here's our risk profile. Are you conservative? Are you moderate? Or are you aggressive? You can be this by nature or this by nature, but what I'm asking you to do is be able to move in and out based off of the opportunity or based on the risk that you're seeing at the moment. So if at the moment things are not as good as you think they could be, but you do want to have some exposure because you think the opportunity is good, you might want to go with the conservative approach. The conservative approach would be executing an initial position by scaling into a third of the total units allocated to the position. So again, remember, if you're using a 100K account, 1%, $1,000 right here is what you can risk, and then you do your stop and you calculate everything, and that's 4 contracts or 3 contracts or 9 contracts, whatever that comes out to be. You can then scale into just a portion of that. If it's 9 contracts, you scale into 3, right? If it's 6 contracts, scale into 2, that type of thing. But for the most part, I really like scaling into an approach, into a third or a half. So it depends on if you're conservative or moderate. If you're moderate and you think it's a good opportunity, you may scale into half. So if you're usually doing 4 contracts or 400 shares of whatever that is, go in at 2 or 200, right? Go in at 2 contracts, and then if price starts to work out in your favor, look to add back, a second half at a favorable trade location. So adding back is very important. You wouldn't add to a scale just anywhere. If this thing's up here, this isn't your time to add. If you got in here, you have to add at the ideal zones, right? A pullback into a trigger zone, a pullback into prior resistance turned support. Those types of things offer the opportunities for you to add that next scale. It's not just anywhere on the chart. Ideally, it has to be at favorable trade location. And ideally, when I add back another scale, or I add a scale, I'm looking to add that scale like I was adding the original entry. So I'm looking for significantly favorable trade location, but that doesn't have to be the case. But that's how I do it. And so if you're conservative, get into a third first, and then you can add to that position by thirds until you're at a full position. If you're moderate, go in by halves. And then if you're aggressive, you can execute the entire full position. So remember, aggressive doesn't mean I'm just aggressive and I'm going to go willy-nilly and just go into a full position just because I'm an aggressive person, aggressive profile, aggressive, Instead, what you want is to be aggressive when the opportunity to be aggressive presents itself. So if the opportunity in the market presents itself to be aggressive, you should be aggressive. But don't just be aggressive because you're aggressive and you want to be an aggressive trader. Do it because there's a reason to be aggressive, right? Sometimes there are some trades that just stick out and you're like, yep, that is going here. It is going to move from point A to B. I know it's going to happen. High odds trade. You can be aggressive. You can get into that trade with a full position. And not only that, you can add to the position as well. So if you have a full position, say your full position is 4 units, and they're working out, if price pulls back, you can scale into additional units and increase that. So for example, I wouldn't go another 4, perhaps add 2. So go half. So if this is 4, add back another half of that and be more aggressive. So that's one thing to keep in mind as well. So there's many different combinations that you can use here, but again, it all goes back to the opportunity at hand or the risk at hand. Is it too risky to jump into a full position? Then, let's consider scaling in. Is scaling in not going to allow you to take advantage of the opportunity at hand? Then it's time to be aggressive, right? So understanding that interplay, I think, is very, very important. Now, with regards to scaling out, this is a really good question by Dwayne, because for the most part, we always talk about scaling out of trades, right? Scaling out. So as soon as price moves in your favor, and it's equidistant to the amount of your stop. So if this is your fixed loss, this is your entry, and it's X amount of points, then when price goes X amount of your points in your favor, you would scale half. And right there, that cuts your risk, keeps your same stop, and then allows you to let the rest run or add back to it. That's my primary approach that I've used forever, right? But now things change a little bit when you go into scaling out in terms of scaling in, Because if you only scale in a third, and this is a singular contract, there's nowhere really to scale out of. You're basically just going to get out of the trade. So for the most part, I treat the scale ins for longer swing moves that I intend to hold for a longer period of time. And so if I'm going to scale in a third on one day, then on day 2 I'll scale in another third if I can, and on day 3 I'll do another third. But by then I'm in a full position, and hopefully by day 4 we're running, right? That's usually the goal. Now you can scale once you've added. So say you have a third, or maybe you have a half, and then you add. Now you have 2/3, or now you have a full, unit. Then you can start scaling as well. But again, usually if I'm not at a full position, I won't be scaling out just yet. I'm trying to get that full position. So, we'll talk about some examples right now. And again, practice with understanding when to apply what is very important. So let's look at some charts here. And I'm just going to go into the live charts. We're going to pop this one up. This happens to be when. I can drop through any of these opportunities here, or any chart, and we'll talk about some good opportunities. There's another question here. What time frame do you usually trade? Hey, Steve. My time frame has been everything over the years. I started out higher time frame, position trading, longer term trading, and then I went to day trading, and also, but while maintaining a longer term as well. So I've had longer term accounts, day trading accounts, everything in between, and then went to day trading and kept the longer term, and then really went into scalping significantly, so I can really pinpoint my entry. So I went to scalping to try and learn that, and got really good at that. And then from scalping and day trading, I've now pulled it back out to swing trading. So for the most part, I am a swing trader lately, but will engage day trades on days where the pace and tempo and volatility and everything is good. So lately, I've said this often in our trading room, that the market was really great for day trading 5 years ago or more. I mean, the intraday ranges were just crazy, and we could make many multiple big time moves in a day. That just isn't the case anymore. It's been a long time since that's been the case, but that doesn't mean that there's still not days where that is the case. It just means as a whole, I think the market is more conducive to swing trading right now, and has been that way for at least a few years. So I typically engage the higher time frames. I'm currently in this trade right now in a couple of ways, but this is one of those opportunities that I really like. Again, nice clear support across the bottom, 160. Very clear support for many months, right? This is back here. This is December. We've been above it since December, January, February, and here we are in March, and we tried to break down through that support and failed. Now, I didn't see this on Friday, but if I had seen it on Friday, there is the potential to get into this trade, and you can dip the toe. So if this is going to turn into a rejection day, or maybe there was something down here that had us in here, right? There is a way to get into this day by dipping the toe, but it's not always easy. Sometimes you can see it, and sometimes you don't see this day until the day's over, or until the next day, right? Once you run a scan and that type of thing. I actually happened to see this past Saturday. We were prospecting with my wife. We come across this opportunity, and I say, hey, this is the one we're gonna ride higher. And so basically, if you were able to get in on this bar, you can dip to toe with a third. I did not. Instead, I got in here, and I always say it's the midpoint of a rejection day that provides the ideal entry or trade location. So you see this day right here, major rejection day, huge tail. It's hard to see right there, but there's a yellow dot right there in the middle. Each of these bars has a yellow dot. And that dot represents the exact midpoint of that session's range. And so when you have a significant rejection, that yellow dot becomes my ideal entry location. And so if the market opens up the next day above that line and drops into it, I want to be part of the bulls that come in to defend and reject that price so it starts to move higher. And so that's exactly what happened, right? Price opened up here, it drops down. I executed a couple of different options trades based on that when price was basically about 159 and change. Somewhere in here is when I executed those trades. But again, it could be options that you're executing here. You can get into the actual equity itself. You can in the underlying. You can do anything you want, right? The idea here is just to get in a portion at a time and let the trade work out. So since I didn't get in on this day, this is the day right here where you enter. This is your ideal trade location. For this one, this is not one that I would want to be conservative because it's a good opportunity. I could have been more aggressive, but I didn't want to be because of the news surrounding the stock. So I'm moderate. Okay? In this case, this stock had been going up super strong. I mean, it's leading the casino industry group right now. And if you look, that's $200. Just a major trend. And the only reason it dropped for 2 days is because Steve Wynn was sexually harassing everybody he saw. And so when that came out, boom, boom, big move down. And perhaps Wynn himself or other big whales came in to accumulate at much cheaper prices. Because what has fundamentally changed about the business? Nothing, really. Wynn did step down, right? He did step down as CEO. But other than that, the business is still doing what it's doing. So fundamentally, nothing has changed. So this accumulation phase was very important. And this breach of that accumulation phase failed. This is what we talked about yesterday in our market structure principles and concepts. The market structure is very clear right here, and price dropped down below it and could not get expansion. Instead, it was failed range expansion. It's that spring. It's the Wyckoff spring idea. And that's my favorite trade. That's your entry. So if on a moderate approach, I guess I could have been more aggressive about it. But the reason I wasn't aggressive is because, again, you have this action, news related, headline risk, and then you're kind of compressed right here. So that's also the reason I didn't shoot for the moon thinking it might come all the way back to 180 or so. My idea was 160 takes you to 170, the top end of the range. So when we talked about market structure yesterday, if this is market structure and you fail to hold below the bottom of this level, then you're going to come back to the top, right? And the top is 170. So 170 is my max profit. If price gets to that 170, I make max profit on the options. I also sold a put credit spread down here. So basically, I sold the 160 at the level that's being rejected, and then I bought the 155 down here. And so I got a credit of about $1.94 there. When I put the trade on, there was only 11 days or so, 12 or 11 days to expiration. And so it's got a little bit of time here to get there. Expires over here somewhere. So we still have a little bit more room to get there. But the goal is I've mixed everything we've learned just in the last couple of days to get this opportunity. A breach of market structure, a great rejection, a great spring trade, a perfect midpoint retest, and then an approach of managing risk that I really liked. I sold this one here with the goal that this thing would close above 160. And the way that I sold this 161 and bought the 155, that put credit spread, I think it needs to stay above 158 and change, 158.50 to get max profit. So it could go like this, it could go over here, it can go there, it can do that, it can even go below 160 and I would still collect max profit on that one. And again, moving nicely higher. Now say I had, let's see here. And now say I had gotten in half the trade. Say I got into half the allowable trade right here. I'm moderate. I got in half the trade there, whenever. Price goes and closes the day bullish, right? It broke through the previous high, closed right here. Ideally, in this scenario, every scenario is a little different, but ideally, breaking through this high, taking it bid, and closing higher, this high and this zone then becomes the add back point right there. So as price opens today and drops into this zone, as long as it doesn't break below this low or below the midpoint, that's your ideal add back. So this is what I mentioned before, that when you add to a position, so you scale in here, that's your first half or first third, whatever it might be. Price goes up and pays you. When price pulls back here, you add your next half or third or whatever it is at ideal trade location, somewhere right here. And by the end of the day, that one's positive, right? And then say tomorrow, price pulls back again and hits the midpoint, that might be an opportunity to defend as this thing attempts to make new highs, right? So then you can pinpoint where that next entry might be. Oftentimes I'm looking at a midpoint or I'm looking at a failed new low. So in terms of failed new low, if price drops below this low tomorrow, any rejection of that low would be an opportunity to slingshot this thing up yet again. Failed new lows, right? Powerful approach. So there's many ways to engage that opportunity here. But number one is day one, you would enter, scale into whatever amount you want. Again, a half, a third, maybe it'd be a fourth. If that opportunity works out, the next day add the next portion, right? Or it doesn't even have to be the next day. You can sit on this. You know, maybe you didn't add today, but tomorrow it drops below the low and starts to reject it. Maybe that's the point to add before the spring higher. So there's many approaches here. Here's another one. This is GoDaddy from a little while back. GoDaddy we had as a great trending prospect here. You can see the uptrending behavior that we've seen out of GoDaddy. Very nice, orderly market. What I liked about GoDaddy is when the market, you know, NQ, S&Ps, everything took a dive earlier this year, late January, early February. A lot of markets, a lot of charts got messed up pretty bad. You know, you got this big pullback. Some did not, though. Some held together pretty well, and this was one of them. And I mentioned that the ones that didn't pull back as much and the ones that continue to honor market structure are going to be the ones that lead to strength when the getting gets good again. When the market turns around, these are going to be the ones that lead. And so you can see this one has everything that you'd like to see out of market structure, out of trending structure. It has so many good qualities to it. Yesterday we talked about market structure. That 151 is great market structure. This level right here is 45. And you can see again this market accumulated here, expansion, pulls back, maintains market structure, pulls back again, ascending wedge, expansion, pulls back again, maintains market structure, boom, expansion. So it had everything. Now when we're looking at this in terms of execution, this was the day we found it. And I mentioned this, as long as it holds 51, this looks like a great opportunity that will take you to a new high. And I think we were looking at 59 or 60 or so, right? Or we're looking for somewhere up here. And so whenever you see that nice rejection tail and you see what you need to see, the next day price opens above and drops into the midpoint. And then at the midpoint, bulls come in and defend, and it closes higher. So on this day, your ideal trade location is right here at that level. And again, if you are confident in this trade, you can go full position at that point and allow it to work its way up. If you're not confident in the trade, which is understandable, very, very understandable after, basically all of the volatility we saw here from the broader market, it can be understandable if you don't want to risk a whole bunch right away. And so this is one of those times where after significant shakeout and volatility here, you may want to dip the toe. And again, if you dip the toe and say a third would be here, price closes higher. Maybe the midpoint is another third the next morning when price pulls back. Maybe it's when price starts to break through highs and run, right? So you can pick a point where you may want to get in along the way. Sometimes you might get left behind, but again, look to the pivot range day over day, because remember, when the market's trending up, right, and you have your pivot range, the next morning it's likely going to pull back to that pivot range, defend, and then continue higher again. That's why the midpoint's so important. The midpoint in an uptrending market is the bottom of the pivot range. 1, 2, 3. The bottom of the pivot range is the midpoint in an uptrending market, and that's the midpoint right there. So when price opens up, it drops. It almost hits the midpoint, but doesn't. But that just tells you it hit the top or the middle of the pivot range and then bounced. When you got this one here, that's your midpoint right there. Price opens up here, drops into the pivot range, and bounces. Right here, that's your midpoint. Price opens at the midpoint and pivot range and bounces. Again, midpoint very, very important. Quick sound check right now. Am I getting any sound? And I know a couple of folks here are not being able to hear. Is anybody else? Okay, Mike sees me here. All good. Okay. Wondering what's up with Steve and Anna here. Eric had the phone call in. Okay. Wonder what that's about. Okay. Well, basically on this one again, everything was in line for the way that you'd want to approach it. You had the great market structure off 51. You had a great trending environment. You had a great rejection. Those are all the things you want to see. And so this may be a time where you might be a little bit more aggressive or moderate in your entry. But after significant volatility and risk that we saw just prior, it would be understandable if you dipped a toe. But otherwise, the goal here would be progressively over 2 to 3 days, you build a position before it does that. Now here's GDX. Now GDX bounced off of a major area of support, 21s. This was significant here, and every rejection is going to be different. Every rejection is different. In this case, we had a significant tail here. I mean, price dropped as low as 2080, and by the end of it was way back above 2160. Huge, huge rejection. When you have that massive rejection, you're not typically thinking that it's going to come all the way back to the mid, because that's a long way to go. And if it went all the way that way, it's probably going to keep going. So this is one of those cases where it opens up, pulls back just a little bit, and then continues to go. But again, being able to dip the toe on the morning pullback, because once you find direction, remember the markets do this. When they find trending, they start to do that. And so if you think about this, this is one day, this is one day, this is one day, this is one day. So after this rally this day, the next day it'll pull back in the morning, rally later on in the day. The next day it pulls back in the morning, rallies the rest of the day. And that's what you tend to see in an uptrending market. So again, when this thing rejects here, you're looking to position yourself at a spot that makes sense. And so again, being able to dip your toe, scale into a portion, and knowing where the other spot is. Now some of these are a little bit difficult. This was just a big high range day that took off to VWAP very quickly. Hard to get into that trade if it's leaving you behind. But again, there's portions in there where the digestion was occurring just ahead of the expansion. So some good stuff here overall. We had another one. This is W. Now, this one has been fantastic. Again, this was another one that had been very bullish. This was the one, along with GoDaddy, that were my best two candidates after everything kind of crapped out in early February. This one had been very, very bullish. It also maintained market structure at 85 on the pullback. So it broke through market structure, pulls back on that wild volatility that we had to begin February, and we had a great rejection tail there. Now, once you see that major rejection, again, I didn't see this till either that day or the next day, so I'm not entering on that first day. The idea is you open above the mid, you come back, you're looking to trigger there, and at that point, you can trigger a half entry, a third, or go full unit if you really believe in it. Now, this is another one where, again, you have to feel the market, because our target for this one was 100. And from this low, if you projected higher, average monthly range, 100 was the 75% target and 104.50 was your 100%. But I mentioned specifically at the time, the market has just done a lot of crazy selling behavior. I wouldn't be overshooting this move. I'd take the profits at 100. And boom, it hits 100, rejection tail. Look at the midpoint retest here, and then a major gap down and drop on earnings. This gave us another opportunity. An aggressive move, another major tail here, and on this day right here, again, here's your midpoint entry. That's the point where you execute your first trade. Whether you're scaling in or going full risk there, it makes for a great opportunity, because this type of impulse sell-off has high odds of returning back to the midpoint of that impulse sell-off. And so again, when price pulled back this morning, it opened up here and pulled back to that mid. This is the one where I have a what is it, the call debit spread, where I'm looking at 75. Was it 75 and 85? 75 and 85 as the call debit spread. This was also on March, and basically at this moment in time, 250 was the amount of debit. Right now, it's costing 710 as it continues to work toward that target. Very, very nice. And again, if you got in here and it worked for you, you can look for the next entry point after that. And again, it's not super easy in this one. It's just been quietly going up. But this has been a good one as well. And just understanding those concepts and those techniques and knowing what to do. But again, the important part of this entire thing is to understand when to be conservative, when to be moderate, and when to be aggressive. And when you have everything kind of screaming at you that this is a great opportunity, this is when you want to be more on this side. When everything else is screaming at you to be more risk averse because the market just doesn't feel right, doesn't seem right, maybe there's no volatility or volume, that's when you want to be more to the other side of the range, right? So again, just being able to move in and out of those in those risk profiles, I think is very, very important. So this one, Eric, gets taken out right here. Basically 85 is max profit on that one. 84.32 would be the actual target. So yeah, for me, I get out at the at max profit. It just all depends, right? It depends on the circumstance. I think this one will likely hit that tomorrow. You're good to go. But very, very nice move. And again, these are all examples. Every single thing we're talking about right now are all examples that we've been working through in the trading room over the last few weeks. These are all opportunities we've obviously scouted in the room, either during the market or pre-market, and then followed along as they've continued to work out. Very, very good opportunities there. 6E is another one here. This is fantastic. Now this one is one where you could have gotten in on the day of the rejection. So this one right here, yeah, max profit is $10 minus the cost of the spread. Yep, in that scenario. That's why if it gets to 85, it's done. It's just max profit is capped there. Right here, that is the previous month's low. A great rejection right there. Major rejection and a push and close outside the previous session's range. That's an outside reversal buy straight from chapter 2 of my book, Secrets of a Pivot Boss. Just perfect. But this day, price was down here when Dwayne brought it up. Dwayne says, hey, we might have a rejection opportunity here in 6E. What do you think? We look it up, and basically none of this bar had been created yet. Instead, it was still kind of like right here. And then before our eyes, it started to reject that low and work its way back to the mid of the previous session and higher. This is one of those scenarios where we saw it early enough to be able to get in a portion on that day. And if the rejection is starting to happen, that is a great time to dip the toe. It's starting to happen here. Let's see if it continues. By the end of the day, it's very strong. The next morning, maybe you want to add back on a pullback. You add another third. You're in good. Maybe on the next day, you add back on another pullback, and now you're in strong as this thing continues to work its way up here. But this was another one, again, where we had it right at the moment where it was rejecting, and this is one of those times where you can enter that trade at the outset. So very, very nice movement. All right, well, I think we've covered up pretty much a lot of what I wanted to cover tonight. Let's see here. In terms of the presentation, we're basically done with the slides. We've gone through a lot of different types of scenarios in Thinkorswim. I think the most important part of this entire thing is just to continue to look for ways where you can mitigate your risk. You can offset your risk in any way. I always think that's very, very important. And it goes back to this first slide right here. Just being able to understand what your risk profile is, understanding what the market is telling you in terms of risk or opportunity, and then tailoring your approach to fit what the market is offering you at that moment. I think it's very, very important. Knowing when to step on the gas, when to put on the brakes, and when to coast. And that's kind of what it's all about. You know, conservative, that's on the brakes, right? You're on the brakes. And then if you're moderate, that's coasting. You're just coasting along in your car. And then if you're aggressive, this is when you're just slamming on the pedal, right? That's the pedal to the metal, and you're ready to go. So yeah, this is an approach here that I've been really, really gravitating toward for many, many years now, and it's the ability to know when to do what based on your feel for what's happening at that time. And again, it all goes back to understanding great, great opportunities and just riding those. When you see an opportunity in the market and you say, that, I got to get in that. This thing is about to go. It's a home run. And you don't hear me say home run often, but you do hear me say it sometimes. For example, like Tesla. When Tesla broke through 290 and started to work its way down, I said 290 is a home run for 390. And it did that trade perfectly. It got to 290 and went to 387, basically. 388, I don't know, somewhere around there. That was a home run. On those home runs, when you feel it and you know it, that's when you can be a little bit more aggressive about your entry. If you don't have the feels, then you got to be more moderate or conservative. Or if you're feeling all kinds of weird about the market, back off. And sometimes no trade is the best trade, right? But understanding when to step on the pedal, when to let off, I think is very important. Over here, portfolio heat, your percent risk, your equity model, all of this goes into a little component of managing your risk. And I think it's all very important to understand how to work in this kind of framework so that you can keep yourself from really blowing out an account. And that's what it's all about. It's about capital preservation, growth, and attacking high probability opportunities. If it's not a high probability opportunity, back off and wait for the next one. And that's pretty much my approach. But again, thank you all very much for joining me for this training. This has been advanced risk and portfolio management. If I can get to the slide, advanced risk and portfolio management, which is part of the core training and the execution portion of the training. This is always really powerful. Again, anytime you're talking about risk and managing that risk, it's the number one type of topic, because you really have to know how to put your chips in, how to bet. It's just like poker or blackjack, right? When the odds are stacked in your favor, you go big. When they're not, back off and live to trade another day. All right, everyone, thank you so much for joining me for this training, and I look forward to seeing you soon. Take care.